The real increase in prices is much greater than what is being officially reported by the government. But I think that, you had this initial spike in a lot of prices, and then the Fed started hiking rates, and that had an impact on the dollar. It had an impact on commodities. You saw commodity prices come down, particularly oil prices, and higher interest rates had an impact in housing and other areas of the economy. And so you got some temporary easing of the inflationary pressures. Also, U.S. GDP got a boost from the strength of the dollar because the initial result of higher rates was a stronger dollar. That brought down the cost of our imports. That helped keep commodity prices down. That also helped boost the GDP numbers. But I think all that is going to reverse. We saw a big drop in the dollar in the fourth quarter. Dollar weakness is continuing so far in 2023. I expect it to accelerate. And that's going to worsen the trade deficits. And that's going to help push commodity prices to new highs. And all that's going to put renewed upward pressure on the inflation numbers. Well, the real problem for the Fed might be that not only do we get a surprise uptick in inflation, but we get a downtick in the economy. It's only a matter of time before we start laying people off. I mean, we're already laying people off, but eventually it's going to be impacted more in the official numbers. Because right now, what's creating all this noise in the jobs numbers are all the part-time jobs that people are being forced to take on because they can't get by on the income from their full-time job. Or some people may have had a couple of part-time jobs and they needed to take a third part-time job. So that's going on right now, because if you look at the data over the last 10 months, we've actually lost full-time jobs. There are fewer people that have full-time jobs now than had them 10 months ago, but you have over 1.5 million more people that now have part-time jobs. Now, some of those people still have their full-time job. They're just working another job. Now, why would somebody who has a full-time job go out and get a second job? Well, it's because they can't afford to pay the bills with the salary from their full-time job. So they need to moonlight. And so that's what's going on. And that's really what is impacting these numbers. As far as why the unemployment number is so low, I know a lot of people aren't being counted as unemployed. And I know a lot of people a couple of years ago made the decision to be self-employed. They got into the gig economy, whether they're driving Ubers or DoorDash or something like that. And so they can never be fired. Once you decide that you're just going to work for yourself, you can't fire yourself, so you can never really be unemployed. So I think there's a lot of noise in these numbers. I think the labor market is considerably weaker than the Fed believes or the market believes. But at some point, all these layoffs that we're getting, and look, more layoffs were announced today. Look at a firm that buy now, pay later company, stock down 20% today, laying off, I forget, a quarter of their workforce. I mean, who didn't see that one coming? I talked about the nonsense of these buy now, pay later companies when they were, all the rage. But one of the reasons that consumers were able to spend money is because they didn't have to pay. They just got stuff for free and they thought they'd pay later. But of course, they're going to pay never. And that's going to be the problem for a lot of these companies because, they fronted the money and now they're not going to get it from their customers. I think that what's going to surprise the Fed is going to be that not only is inflation going to turn higher, but the economy is going to turn down. And so will job creation, and unemployment will go up. So inflation will be stronger than the Fed expects. The economy will be weaker. Now, what does it do? That's the $64 trillion question. Is the Fed in a weakening economy and maybe even a financial crisis? Who knows what might blow up? Because interest rates, they're almost 5% now, and they're going to be 5% pretty soon. We were at 0, so that's a huge change. You built an economy around 0% rates. It can't function at 5%. The whole thing has to implode, which is a good thing because we had a phony economy and that needs to implode. But when it does, it obviously creates a lot of problems. A lot of people are going to lose a lot of money. That's not going to be something that the government is going to want to sit by and just, watch it play out. They never do. They always feel compelled to intervene and do something, even if what they do makes everything worse. But will the Fed sit back, or will the Fed rather fight inflation and say, to hell with the economy or the labor market or the financial system or the stock market? We don't care. We're going to fight inflation. We don't care what's happening in the economy. Or are they going to say, we don't care about inflation. We got to go help the economy. We got to do something about what's happening in the economy. And of course, the only thing the Fed can do is create inflation. That's the only thing it's ever done. That's its only tool is inflation. So the Fed is going to have to say, yes, we have high inflation, but we're going to make it even higher because we feel that we need to do that to help the economy or the labor market. It's going to be a huge recession. I think it'll be a bigger recession, a deeper recession than anything we've experienced in our lifetimes. Because a bust is proportionate to the boom. And this has really been an unprecedented boom created by the Fed, created by artificially low interest rates and quantitative easing. And so this could be one hell of a hangover. That's what's going to happen. You're going to have recession and inflation happening at the same time. And that's what's going to make this recession so much more painful, because even if you don't lose your job, it's going to hurt. And I think most investors are going to lose money. I think most investors over the last decade or two have been channeled into the wrong assets by the artificially low interest rates. So a lot of people own very high multiple companies, growth companies, and in fact, companies in many cases don't even have any earnings at all. Right? They were just speculating on earnings in the future. But people were willing to do that when the cost of money was basically zero. But I think as the dynamics change, a lot of people are going to realize that they're holding the wrong assets and they're going to get repriced and marked down. So, there's going to be big losses for most investors that, have the FANG stocks or a lot of these stocks that did really well, when the Fed was blowing up the bubble, but they're going to do horribly when it bursts. Cryptocurrencies also got caught up into the speculative mania. And, the air is going to come out of that bubble too. So a lot of people that had a lot of money, or at least they thought they had a lot of money in their digital wallets, are going to find out that there's really not much there. I mean, they'll still have the crypto. They just won't have much real money if they try to sell it.
What are the assets that you're most excited about, or that you think the average individual likely will end up benefiting if they are positioned correctly?
Assets that are ultimately going to do well are, one, commodities. I think commodities are going to do extremely well in an inflationary cycle, and that's all sorts of commodities, industrial metals, agricultural commodities, oil and gas. So I have investments there, and of course, precious metals. They're going to do very well. Gold's the king of all commodities, and I think it's going to do very well. But I think that there'll be a lot of money lost in bonds, paper assets. I think that people that own quality real assets will do better. And so that's the value stocks. I mean, companies that actually have big earnings right now, not companies that might earn money in the future, but that earn a lot of money right now and have been earning a lot of money in the past, so that the income is reliable and dependable. And the companies are selling goods and services that people really need to buy. And they'll buy them. I mean, maybe they'll buy a little bit less, but they'll keep buying, and they'll cut back or give up something else in order to buy these things. And so you want to own those businesses. And I think, overseas markets will do better than domestic markets here in the United States. And I think equities will do better than bonds, but it depends on the equity. I mean, because there are stocks that are going to go bankrupt, and that's, you lose 100% if your company goes bankrupt. But a lot of stocks that won't go bankrupt, investors will decide that maybe they're worth 10 cents on the dollar or 5 cents on the dollar relative to what they thought in a very different investing environment.